Hi there and good evening. You're watching News Now with me, Ruchi Bhatia. Let's quickly look at the global markets. It's a carnage across global markets once again, despite the US President Donald Trump promising almost a $1 trillion economic stimulus package. There seems to be no respite. On your screens there, Dow at opening is already down close to 1,300 points. Just look at the global markets, almost an unprecedented volatility that we are seeing on account of the coronavirus outbreak, the cases for which have surpassed close to 180,000 across the globe. In fact, if you look at the European markets today as well, we're seeing a slide across European markets too, despite the multi-billion-dollar stimulus pledges by various governments. As far as the oil markets are concerned, there also we're seeing the Brent, in fact, seeing a level of close to $25 per barrel. This is the lowest that we've seen for Brent as well. In fact, let's take it across to Ryan Sweet. He's joining us on the phone line. Hi, Ryan. Let's begin with the U.S. markets. Yesterday, we did see U.S. President Donald Trump announcing that close to $1 trillion economic stimulus package. We're really looking at a helicopter drop of money to the people, as well as the governments are looking to battle the coronavirus outbreak and are looking to ensure that their own economies do not suffer. Yet there is absolute pandemonium in the market. What's it really going to take to restore the confidence?
Well, I think that's the key question, and I think right now, even though President Trump made, hinted towards this $1 trillion stimulus package, I think markets need clarity. I mean, they need to see the nuts and bolts of the package. They want it passed, and they need to see the money flowing out. And it's unclear when that's going to happen. I mean, time is of the essence, and I think markets realize, and what economists have been arguing for quite some time, is that there's gauging the severity or the economic impact of the coronavirus on the U.S. economy and even the global economy is contingent on the policy response. You see central banks acting across the world and very aggressively. Fiscal policy has been acting pretty aggressively outside of the U.S. Really, there's a sense of urgency within the U.S. fiscal policy that they need to act, they need to pass it, and the money needs to start flowing. And then I think you'll start to see, hopefully, some common markets. But volatility is just off the charts. If you look at the VIX, it's up where we were during the financial crisis.
Well, absolutely. In fact, if you look at all the three indices, there also we're seeing a lot of pain. Ryan, despite the pledges that have been made by the global governments, we're seeing the markets are really taking it on the chin. It's no longer it's no longer a financial crisis that we're talking about. It's moved way beyond that. Do you think the governments of the day really understand the kind of pressure that they're dealing with at this point of time? Because these are not ordinary times. We're talking about unprecedented times, and which is why the governments have to think out of the box. Do you believe that?
No, I would agree with you. We're in unprecedented times, and I think that's contributing to a lot of the volatility in equity markets. And no one knows how this is going to play out. Economists, we have no idea how this is going to play out. I mean, we have to make assumptions in our forecast, and that's why we have alternative scenarios. There's a case that the situation could be better than we expect, or there's a much darker scenario for the global economy, for the U.S. economy. But really, no one has any idea how long this is going to last. The coronavirus, or the overall economic cost that it's going to deliver to the global and the U.S. economy. And I think that's really putting a lot of pressure on fiscal policymakers. It's putting a lot of pressure on central banks, and it's weighing on the equity markets. I think the equity markets just realize that they know we'll get on the other side of this. They just don't know when. And I think it's really, the markets are very sensitive to the day-to-day headlines on the number of reported cases across the globe. And until we get that curve begins to flatten out with the number of cases in the U.S., I think equity markets are on for a pretty wild ride.
Oh, absolutely. Ryan, if you look at the global markets, in fact, the US markets at open, S&P 500 has declined close to 5.5%. Dow has fallen more than 1,200 points, and NASDAQ also has dropped over 4%. And many say that, every time we see such kind of volatility, we perhaps, if this kind of situation persists, we're once again looking at everybody talking about deglobalization once again, and protectionism could be the big theme for the upcoming decade as well. Do you concur with that view?
I think that's a debate for another day. I think right now the focus should really be on the public health crisis globally, and I think that's what a lot of governments are really honed in on. The trade war has taken a backseat. This idea of protectionism should take a backseat. I mean, countries are closing their borders not because they're being protectionist. It's because, in a sense, they are for public health reasons. But I think this is something that, we could debate, once we get on the other side of this. I mean, right now, priority number one is addressing this public health issue. I think that's what markets want. Markets want, further central bank action, which they could get from, the Federal Reserve. You saw it last night when they launched another credit facility. They want fiscal stimulus, signed, sealed, and delivered. Hopefully that is coming down the pipeline. But, I think the key thing right now is uncertainty, and markets don't like uncertainty. And this is a period of time where uncertainty is significantly high.
Oh, absolutely. In fact, we're expecting U.S. President Donald Trump to make an address in about 2 hours from now. But any amount of fiscal or monetary action by the administration of the day, do you believe that will be enough to assuage the fears that we're talking about?
Well, within markets, I think it could help a little bit, because I think once they see the details of the package, the timing of when the money's going to flow out, then markets could start to assess, what the shape of the recovery is going to look like. It could be a V-shaped recovery where the economy falls sharply and then bounces right back. And I think for that to come to fruition, you first have to address the public health issue and, get your arms around this and contain it. But fiscal policy or fiscal stimulus, monetary stimulus, that will all help juice the economy when it comes back. There's a U-shaped where we fall sharply and then we bottom out for a period of time and then begin to recover. But I think markets are looking more for a checkmark type recovery where the economy falls and it's just a slow recovery because there's just a tremendous amount of uncertainty about the duration of this current public health crisis and the overall economic impact. And lower oil prices are also weighing on market sentiment, and I think they're just bracing for the worst. And you're going to see the economic data in the U.S. and you're starting to see it in China, in Europe, is going to look pretty awful.
Absolutely. Ryan, just hold that thought. Also joining us on the phone line is Arnab Das as well. Hi, Arnab. Good evening. Even yesterday when we were talking pretty much around the same time, we were talking about the unprecedented volatility in the markets. Today as well, we're seeing the U.S. markets really taking it on the chin. Dow plunging close to 1,000 odd points. Extreme volatility that we're seeing in the U.S. markets, even as the U.S. President Donald Trump will be addressing in about 2 hours from now. Do you believe that the administration of the day has enough ammunition with them to deal with the kind of outbreak, the financial health emergency that we're talking about, which is going to have a massive impact on economies around the world as well?
Yeah, I think that is the central issue here is that the response to dealing with the outbreak, the public health response to dealing with the outbreak, involves very recessionary public health measures. So I think what the market and the private sector as a whole, both households and corporations, and the financial system by extension, are dealing with is this realization that's been dawning over the last several days, trading days, right? That we're going to have not really a kind of conventional recession, right, but an abrupt shutdown in various kinds of economic activity. Not all economic activity, right, I have to say, not the government not purchases of basic necessities by consumers. A lot of stuff is going to continue to go on. And, of course, the health system is going to continue to function and have to be ramped up. But many other kinds of activities are going to shut down for some time. So the question about whether the government in the U.S. or in other countries has enough resources, I think is absolutely the right question. But the issue here is that the markets will provide those resources, because even though bond yields are rising today, the levels are still very low, and that's because there's a dash for cash still going on. The underlying issue, it seems to me, is that fiscal policy and monetary policy can only, as we've discussed before, can only really cushion the blow here. We will have to go through this downturn, and then, the question, as was just being said, is how long does the downturn take, and how pronounced or graduated is the recovery?
Right, absolutely. Just hold that thought, Arnab. Let me take it across to Peter Cardillo as well, who's also joining us. Peter, we heard the U.S. President Donald Trump yesterday saying that there's going to be a $1 trillion economic stimulus package that they're working with. We're talking about a helicopter drop of close to $1,000 for every U.S. resident. This is really the most progressive, a quick thinking, if I should put it like that, by the U.S. government. But is it really going to be enough?
Well, the markets don't think that, but obviously, with the Fed doing what they've announced and they're going to do, that is massive quantitative easing, and a real bazooka from the administration, I think it would probably be enough to cushion the economic decline, but the markets are fearing something greater here. And I hate to use this word, but from what I can see is that there's a good chance that we might be headed for a period of deflation, and that would just simply mean that whatever the Feds or the government does is not going to really help us, because this morning, in fact, Treasury Mnuchin said expect high unemployment. Well, how high is high? And if we are about to reverse everything that the administration gained in employment to unemployment, that's a very scary thought. And of course, with a possibility that many states are about to lock down, you can just imagine what that would mean for, let's say, two states in particular, California and New York. You can just imagine how many jobs are going to be lost. So I think that's what the market is really fearing here. And when you see a breakdown in commodities, and the big surprise here is the price of gold. The price of gold should be going through the roof, and just the opposite is happening. So there's just a lot of fear out there, and everyone is selling everything to raise cash. And we're seeing that in the Treasury market, where rates have gone back up. The 10-year is back up to 1.2%, and we saw that, and we're seeing that with the strength of the dollar. So it's just a fear factor that's accelerating, and we just have to wait and see. And hopefully that, we can get this $1 trillion economic package in totality. That's another question mark.
Well, absolutely. Let me try and get Ryan Sweet back. Ryan, we're seeing what's happening in the US markets, but the big fear is that while the West has seen a gradual increase in the cases of coronavirus, India is going to be the next big epicenter. There's going to be an avalanche of cases that we will see in countries like India as well. And on the back of which we're seeing the Indian markets also extremely nervous. We're close to the 3-year lows as far as the Indian market goes. Where should an investor really park their money at this point of time? Because there's no relief in the global markets, in the developed nations. There is no relief in the emerging markets as well.
In these periods of high volatility, it can be very trying as an investor. As an economist, I can't give financial advice. The stock market, it goes up some days, it goes down, it's all over the place. So I really don't want to provide any financial advice. I mean, from an economic perspective, the global economy is going to suffer, the U.S. economy is going to suffer. It's the question mark. It really is just how bad is this going to be for the economy, and from a public health perspective, how much worse can it get? Governments have to make a tough choice. I mean, the U.S., you're starting to see states begin to slowly shut down here in the United States. And even though that instills a lot of economic pain and has a high economic cost, according to the doctors and the CDC, that's the right decision for a public health perspective. So, when people ask me and they're checking the market every day, I just say, don't look. Don't check your 401k every day. Don't look at the stock market every day, because it's just it's a very trying time right now in markets and for the broader economy.
Oh, absolutely. Peter, if I can, get you in on that, we still don't know the kind of impact, at least we will see, or at least on the global growth. `What's the number that you're penciling in? What's the number that you're working with? There is a massive impact on the hospitality sector, on the airline sector, on tourism. What is going to be the cumulative impact of the business shutdowns, of economy really coming to a grinding halt due to coronavirus, that it is going to have on global growth?
Well, look, I just revised my Q1 GDP, and there's a good possibility that we could drop as low as maybe 0.2%, followed by a 7 or 8% in Q2 and Q3. I'm not going to give you on individual sectors, because that would basically be useless at this time. And besides, I don't want to give any particular sector a number, because I would just have to stick to general terms. And so, let me put it to you this way. When you have oil crashing to 16-year lows, and there's a good possibility that we might even get into the $15 or $17 range, that's a very negative sign for global growth. And so, as I said before, I think this market is now beginning to fear deflation. So it's a fear factor. I'm not saying...
absolutely. Oh, totally, Peter. We totally, get the kind of perspective that you're sharing with us, especially on oil prices. But on that note, we're completely running out of time. Ryan Sweet, Arnab Das, as well as Peter Cardillo, always a pleasure chatting with you. But as Peter was pointing out, oil continues to be another, area that we will be focusing on. There's no respite in the sell-off coming in for oil prices as well. We're really talking about an 18-year low as far as oil prices are concerned.